Yeah. In this session, we will be looking at assessing the quality of the risk measures, majorly from the model risk and model errors perspective. So, the VAR models that we are going to create, what is the flaw or how do I assess the quality of those VAR models which are useful for creating or computing the value at risk. So whatever the risk measure or whatever is the outcome that comes up, there could be a lot of variability in those values with the change of the assumptions, with the change of the data, with the change of model which we are using. So that is where we are trying to understand what are the measures that could be used to understand the risk or the quality associated with these risk measures. And of course, there are a couple of small case studies regarding the failures during 2005 and 2008 and 9 because of usage of the wrong models or because of the wrong measures of risk is what we would be discussing also. Now, just to start off, we are talking about model risk. In this, the prime thing is the model which is being used to construct the value at risk. We are trying to see where that at what all locations can the error come into the model. So when we talk about the model risk, we are talking about failure in the risk management mechanism, not able to implement risk management properly because of the wrong usage of the model, right? Either because of incorrect specifications given into the model or because of incorrect application of the model or because of various things, we see that the model risk can typically crop up. But apart from the losses from those dimensions, this may even lead to a reputation loss or reputation risk. Some regulatory kind of risk can crop up, legal risk can crop up, which can create the situation of the company even more pathetic. So, so they primarily occur because the original model that we are using to compute the risk measure, whether we are using VAR or expected shortfall or even a standard deviation, whatever the model which we are using to compute the risk measure, there could be a problem with the model itself or the inputs which we are using to derive our empirical based model. So the problem could be existing at any of those levels. So that is what we really need to understand as a part of this session. And when we talk about the various sources of error, they can come right from the programming perspective, right? So basically, I'm not able to comprehend the algorithm properly, not able to do the proper programming, the programming language, not able to accommodate the logic properly, or incorrect conceptualization of the logic. All these things go as a part of the programming error. Then the second dimension is the valuation related error. We not able to really comprehend the true value of the security or true value of the hedged instrument. So understanding the risk associated with the underlying instrument and based on that designing the appropriate hedging ratio. All these things, if there are errors in the conceptualization itself, not of the programming stuff but more in terms of conceptualization of the business itself, it can lead to market risk where the buy and sell decisions get completely flawed, which could result in losses cropping up, or it could even lead to your operations risk where the profits are not recorded properly. And the estimates that are used to compute the VAR, especially the time period which I am using, the frequency of the data that I am using, the underlying distribution that I am using, distribution of the asset prices and returns I am using to model the VAR. So the errors could crop up even at that layer also, which could be a flaw to our model. So even that thing really need to be understood. But overall, and even incorrect position mapping, right? So how do I map the position? Do I map the cash flows to the risk factors, or do I map the duration or convexity of the instruments to the risk factors? So what should be the typical underlying positions characteristic that I map to the risk factors? That is also one more area that could lead to a model risk. But one thing is for sure, any of these risks that are cropping up, if I am doing a proper mark to market, the risk can be reduced completely significantly. But of course, the marking to market may not exist for all the securities, especially for less frequently traded securities like long term loans, or where there is a lot of illiquidity associated with the securities. We see that the marking to market is not that feasible. So that is where we may not be able to depend on the mark to market kind of a mechanism, and that itself could in turn result in some kind of risk getting crept up into the model. Now, what are the various factors that impact the VAR estimate? Because most of the times what we see is VAR is not a stable value. VAR keeps changing, probably with time, with the risk characteristics changing, right? The past lessons learned, and could be a modification to the current risk profile altogether. Because of various scenarios, we see that the VAR at a point of time keeps changing. So whatever is the VAR based system that any company is either internally developing or purchasing external, both of them can happen. A VAR based models internally, the big companies generally tend to develop the VAR based models internally, but there could be a kind of tools kind of thing that are generated by external vendors, and they could be generally purchased by small companies. But whatever are those, the VAR model that we are typically looking at, we see in any kind of a risk measure that we are developing, three types of data is very much required. One is the market data. Market data is about the share prices, exchange rates on a generally a time series basis. Last 1 year security prices, last 1 year commodity prices, last few years interest rate changes. All these are generally in case of time series kind of a thing. But the major thing that we need to do to use it as a part of the VAR estimate is remove errors. Probably there could be lots of outliers in our data, some abnormal values coming out because of some exceptionally high or exceptionally low prices on specific dates. So whatever you think are abnormal or erroneous kind of data points, you just omit them, remove those errors, and even if there are some missing values, some data is not available for some reason, see, come out with a mechanism of how that is handled. But of course, this entire process of obtaining market data for a good number of securities sometimes would be a costly operation also. So that needs to be understood quite heavily. Then we also have the securities master data. Probably if I'm talking about a bond or any specific security, a lot of things which are exclusive to this bond, the coupon value, the maturity date, the number of units that are held by the company. So security related stuff, right? Even including the equity, the shares of some company. Okay, how many shares are there? When were they purchased? What was the price at which they were purchased? All these things typically is being contained as a part of the security master data. So more from a credit risk modeling perspective, or even from a market risk modeling perspective, this data is very important. So there should be a clear understanding of the sources of this data. Then the third kind of data that we are talking of is position related data, which is more and more of the various trades that have been performed across the various trading platforms, could be exchanges, could be OTCs, the various positions the company has on various exchanges in various trading systems. It has to be collected because sometimes the trading might be just on notional values. Sometimes the instrument could be created not with the purpose of holding but with the purpose of trading. So for all those cases we may have a position kind of a data. All that need to be captured from the various trading systems. And once we have computed all that, once we have collected all that data, a normal VAR model is built. And the var model, whatever comes up, once the data changes slightly, there is a possibility of the var value also changing drastically. So what are the things that are contributing to the variability in those var measures? Most of the times what we see is the computation of the var, managers have their own discretion in terms of identifying the parameters. So that would lead to some extent the instability of the parameters. So the confidence intervals get affected, the time horizons get affected, which means the var computation also get affected, because I don't know, I can use any amount of confidence interval, I can use time horizon, so two different people can compute two different vars altogether, although the underlying risk is the same. So that is one thing that can impact the result. And the measurement also, the data that we are taking, the time period, the frequency, the formula, the distribution, should I assume that the prices follow a log normal distribution or a normal distribution? And do I assume that the volatility, right, the volatility, is it uniform across the period, or probably use some kind of Garsh kind of a mechanism, or Arsh kind of auto-regressive kind of models, or exponential weighted moving average kind of a model. So based on how I am varying the input parameters, I see that my VAR estimates or risk measure calculations also get affected accordingly. So we have to really ensure that these data are captured into the model quite effectively. Then the next dimension that is worth looking at is mapping of these risk factors to the positions. So either I do a cash flow mapping to the risk factors, or I can do a duration or convexity mapping to the positions. So which means I try to identify what could be the estimated cash flows in each of the periods, and based on that I associate risk factors to them, or I try to compute the current duration or convexity associated with my positions and try to map the risk factors to them. So the former one is accurate but very difficult to compute, whereas the later one is easy to compute. So, and at the same time, because there are very few risk factors, the data errors can come down, the model risk may come down. So sometimes we may have to have a compromise between accuracy versus ease of use. So which specific risk factors are impacting our calculation, and getting the data of all those risk factors is going to be a very tedious exercise. And sometimes we even come across the liquidity risk. Whatever the model has predicted, and probably giving a buy to sell kind of a decision, and the real market risk. So because of that huge difference, it may so happen that I may get a sell decision, but I may not be able to sell the security at the price which my model is suggesting. I may have to really compromise on the price and sell it at a much cheaper price. Or if I want to buy it, the model is based on the market risk, the model says that you can buy it at X, but because of the liquidity issue, I may not be able to buy it at X, but I may have to spend quite heavily to purchase it at much more than X. So whatever is the difference that is coming because of the model price versus the market risk is what we are associating to liquidity risk. So while computing our model, even that liquidity risk has to be taken into consideration, and the impact of that needs to be considered. Then there is also a possibility of basis risk coming up, especially when I'm using the risk in X and trying to hedge it with Y. If X and Y are not moving in a similar way, or probably they are not having a linear relationship between them, there is a possibility of basis risk arising between the two. So if the position that is getting hedged and the instrument that I am using for hedging purpose, if they are not properly correlated, that could definitely give rise to a basis risk. Even that thing have to be mapped with respect to the positions. And sometimes event driven strategies also impact the positions quite badly. So whatever the VAR that we are getting, just because of let's say an M&A event occurring, or some other specific event occurring, even there my VAR estimates can get very much distorted, right? Even a bankruptcy coming up, any lawsuits coming up, so just based on the historical return, I may not be able to compute my VAR, because these are something that are adding additionally to my value at risk, and that will occur only for some period of time after the happening of that specific event. So that is where probably I may think of using a dynamic risk where the risk keeps changing with time. Even that thing has to be looked at while building my model for estimating the risks. Then looking at a couple of small examples. In 2005 there was a model risk, or probably a failure of a model. The long equity tranche and short mezzanine credit trade in 2005, this did not work, primarily because of misinterpretation and incorrect application of the model. Not all risks were hedged, only few of them were hedged, and as a part of the strategy, it was primarily to sell the protection on the equity tranche and buy the protection on the mezzanine tranche. Now, equity tranche is what? It's high risky tranche, whereas mezzanine is in between the bond and the equity, so there is considerably low risky kind of a tranche. So when I am buying the mezzanine tranche, right, when I am buying, so it's as good as like I am buying a protection, or probably I am buying low risky. Probably if you have to translate it quickly, it is nothing but buying a low risky bond and selling a high risky bond. So think of it like this: when you have bought a low risky one, probably the premium is much lesser. When you have sold a high risky one, probably the premium is much higher. And when you have bought a low risky bond, in case there was a default, you are protected against it. And when you are selling a high risky one, you are offering protection to the counterparty on the same. So you have received heavy premiums right now. And so here what you are doing is you are long on the credit spread on the equity, and you are short on the credit spread on the mezzanine. So if the credit spread widens on the equity tranche, it's a benefit for you, and if the credit spread narrows, it would be a benefit on the mezzanine tranche. And because of that, you are expecting a positively convex payoff profile, and initially the default risk was neutral, so there is a possibility to benefit from the volatility in the credit spread. But because of the heavy volatilities in the credit markets and bankruptcies, this led to huge sell-offs, and the spread widened very badly, which has resulted to the failure. So that was a wrong model, which was created, as well as a wrong application of the same, led to the crisis altogether. Then the similar kind of a scenario occurred for residential mortgage backed securities, where the systematic risk was underestimated. The simple thing was, initially it was assumed that in the mortgage, in the housing, residential housing market, it is expected that in the future the prices are going to rise, and if they are not going to rise also, they may remain stable, but no one expected that they are going to fall. So because of that, the default rates were underestimated, because they expected that this is going to rise, so collateral is going to be of a stronger value. So because of that, there is no point in taking strong other credit enhancements for the same. So even subprime kind of loans have been offered because of this major assumption. And they also assume that the correlations across the housing sector of major geographies, it is independent, it's almost not existing. So probably state 1 versus state 2, they have assumed that the correlation among the housing markets of these states is very low. So the default in this state may not trigger a default in this state. They assume that these are all independent, so the overall risk levels may not be that high. But what had really happened is, when the economy did not perform well, these things became very much problematic, which has resulted in strong correlations between the various housing sectors across the various states. So when this has resulted in a downfall, even this has resulted in a downfall, and overall losses have got aggravated. So just with the assumption into the model that the future prices are not going to fall, and the correlation between the two is almost negligible, that has resulted in a complete underestimation of the systemic risk, which means after a few periods it has resulted in heavy downgrades. Initially, all these mortgage backed securities were given something like a AAA kind of a rating, but within no time they had to be downgraded. And of course the companies had to compromise with had conflict with the rating agencies on their compensation. So it is said that the rating agencies have downgraded their ratings, but for whatever may be the reason, we have seen that the higher graded ones, AAA kind of ones, they have lost 70% of their value, whereas slightly lower rated kind of mortgage backed securities, they became almost zero. They completely lost out. So that is how the model risk can have very serious implications on the performances. So that is where it is very much required for us to assess the quality of the risk measure, especially while once we have built the model, assess the quality of the model for the calculation of the appropriate risk measure. In case you have any further queries on the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.